Gold made a V-shaped reversal, and the bulls and bears are still evenly matched. With a non-stop stream of tariff and geopolitical headlines and challenges to the US exceptionalism narrative, how should we be trading gold? For more, check out this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Over the past week, gold saw a V-shaped reversal, but the battle between bulls and bears continues. More dovish expectations for Fed rate cuts and the looming US government shutdown have supported gold, while the White House's tariff policy and some geopolitical developments have kept traders on edge. This week, traders will focus on the US ISM Services PMI, the non-farm payrolls report, and Powell speech as well to adjust their gold positions. Looking at the gold against US dollar daily chart, we can clearly see the V-shaped reversal early this week. After last Friday's drop below the 23.6% Fibonacci retracement of the upward trend since December, bulls managed to push the price back into the $2,880 to $2,900 range, the lower end of the mid-February consolidation zone. However, the anticipated trend did not materialize, and today, selling pressure has emerged, testing the 5-day EMA. If bearish momentum continues, support may be found at $2,880 and $2,868. While on the other hand, the upper boundary of the consolidation range at $2,940, which has been tested multiple times, could limit the upside. Well, the two key factors driving gold and, I would say, broader market movement right now are undoubtedly tariff policies and geopolitics. Given the constant policy flip-flopping in the US, it's not easy for traders or analysts. Every morning when I wake up, I'm prepared for my views from yesterday to be completely overturned. The White House's wavering stance on tariffs against Canada and Mexico has been confusing. And initially, with the tariffs being implemented, some traders had already started reducing their gold hedge positions. However, the frequent shifts in US policy and warnings of potential retaliation from the two countries have caused long positions in gold to accumulate once again. And in contrast to its somehow ambiguous stance on its allies, or I should say previous allies, the US has shown no leniency toward China. The extra 10% tariffs on China, along with China becoming the first country to really implement retaliatory measures by imposing tariffs of up to 15% on US imports, have significantly heightened market risk aversion. Furthermore, the president's emphasis on imposing reciprocal tariffs starting in early April and his opposition to currency devaluation, particularly targeting China and Japan, has only intensified the tension. And from a geopolitical standpoint, the meeting in the Oval Office clearly haven't helped ease tensions. Increased cooperations between Canada, the UK, and Europe, the EU's proposal for 150 billion euros in loans for pan-European defense, and potential US-Russia cooperation based on mineral resources suggest that the global geopolitical landscape is being reshaped somehow. And moreover, while overshadowed by other headlines, if the US Congress and the Trump administration fail to reach a new agreement by March 15, the US government may shut down. So this kind of developments are all fueling safe haven buying of gold. In the current environment of frequent updates on tariffs and geopolitics, traders are forced to frequently reprice their expectations of market trends, which is, I would say, objectively favorable for gold. And at the same time, recent US economic data has softened. The ISM manufacturing PMI and consumer confidence both came in weaker than expected. Inflation is under control, though, with the January core PCE rising just 2.65% year-on-year, the slowest annual increase since early 2021. These factors have caused the US Treasury yields to drop significantly, and the market is now pricing in 325 basis point rate cuts by the Fed this year, which supports gold as a non-yielding asset. However, as we mentioned last week, long-term inflation expectations in the US have hit a 30-year high, which could be a bearish factor for gold in the medium to the long run. So overall, while gold bulls have re-entered the market this week, the uncertainty surrounding tariffs, geopolitics, and also the US economic outlook is likely to keep gold in a consolidation phase. Over the remainder of the week, in addition to any unexpected news or headlines, U.S. economic data, including the ISM Services PMI and the non-farm payrolls report, as well as speeches from federal officials, will be key to watch. On the data front, the market consensus is that the February services PMI will come in at 52.9, showing a slight improvement compared to the previous month. And in the labor market, the consensus is for 160,000 new jobs added, up from 143,000 last month, but still below the 237,000 average over the past 3 months. The unemployment rate is expected to remain at 4%, with average hourly earnings slightly lower. While neither of these data points is likely to significantly affect the Fed's policy outlook, I believe that if the services PMI falls below expectations and new jobs come in below 140,000, especially considering that the Doge layoff have not been included in the year-on-year comparison, concerns about the US economy could provide a slight boost to gold. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data and events might impact gold trading, drop a comment below and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!